Hi, and welcome back to the First Time Homebuyer Guide. Today, we're going to talk about debt to income 101. Um, going, reviewing what we've talked about, credit is probably one of the biggest things. And I'd probably say debt to income is probably number two for maybe some of the hurdles that people have in qualifying for a home.
You know, usually debt to income is something that we as a lender really scrutinize. As a borrower, you probably are not aware, what these are. So we'll try to point that out a little bit.
Yeah. And this will tie into, we know what your income is. We talked about the income portion, and credit. When we pull a credit report, that shows what debts you have. So this is kind of a marriage of some of those ideas and what lenders are looking for to help you out. So what is debt to income? It's a ratio that lenders use to protect borrowers and themselves from foreclosure. Again, they're in the business of lending. They lend you money and then they ask you to pay it back with interest. So they want to make sure that you'll be able to do that. And they use this ratio to make sure your debt isn't too high compared to your income. So let's use the example of Caleb. Caleb is looking to buy a home, and his debt includes credit cards, student loans, a car loan. And for the income, we can use anything that is verifiable and acceptable. If, again, we talked about this in Income 101, what kind of income that is. But let's say that Caleb has a debt of $1,500 a month from credit cards, student loans, and car loans, and an income of $6,000. And we'll say he has a W-2 job. His debt to income ratio would be 25%. And so the question is, well, what ratio are lenders looking for? What are they comfortable with? Lenders have a ratio, and the reason they have the ratio is because they don't want to stretch you too thin. They want to make sure that your income can cover all your needs. The ratio that they have is generally around 43 to 47%. This is the First Time Homebuyer Guide. We're trying to help you get the best loan. The best loan for a first-time homebuyer in general, unless things change, usually it's a conventional loan. It's qualifying with a high FICO score.
So sometimes the FHA loans will let you go the higher debt ratios, but
the interest rate's higher. The monthly payment's higher.
Monthly payment's higher. Interest rate may not, and this is interesting, interest rate may not be higher.
It might be lower.
But it has a higher mortgage insurance. Therefore, the total payment is higher. And the government FHA loan will let you go higher a little bit on the ratios, but anyway, they're very close. Usually about a 45 debt ratio is about the normal. We don't want to stretch that too far. 46, 47, you're starting to stretch it. And that depends on then, do you have the higher FICOs? Do you have, what other items
do you have assets?
Exactly.
What can we do to strengthen your case?
Right.
So again, this number, the maximum debt to income ratio, is subject to change by everybody is different. So your ratio is going to be different.
We've seen them higher than this, but this is giving a good general guideline.
If we're
here.
looking at like a bell curve, this is hitting like 90% of where buyers need to be. So let's say Caleb comes into us and he says, hey, I want to buy a home. And we started looking up, and he wants to buy a home. He's going to have a $2,000 a month mortgage payment. So if we add that to his current debt, he is at 58%. And at that point, he would not qualify for a loan.